All right, so this is our outline for tonight. Okay, so we have, we are going to be talking about these very, now when you're starting out in trading, the first thing you want to know about is risk management. Risk management is by far the most important thing you have to learn first. All right, so before we go into how to pick a trade and all that, the first thing I want to go into is risk management, money and risk management, right? Because eventually, by the time you know all the strategies you need to know, learn how to mark up the charts, learn where supply and demand is, support and resistance, supply and demand structure, break and retest. By the time you know all those things, you still have to use risk management to make sure that you protect your account, you protect your money, right, on every trade. Because, for example, if you have $1,000 on a trade, how do you pick your lot size in such a way as to protect them? Even when you are guaranteed, you are sure that a trade is going to go well, there is still a way to set your lot size in such a way as to give your trade room to breathe while you put to use the right risk management principles, the right money management and risk management principles. All right, so if you're trading, if you're entering a trade, no matter how guaranteed the trade is, you are not going to put all your money into one trade. All right, so you're not going to put money. Even if you do that, I do that sometimes, but there are some kind of monies are like that. You can have $100 and you say, I'm going to put this $100 on this trade, right? Because you know something, but generally that's not the way to trade. That's not the way to trade. All right, so that's why that's why our first goal is risk management and money management. It's very, very important, right? This is how not to lose your money on a trade. This is how not to lose your money on a trade. A trade, you can have a trade that goes bad. You can have a trade that didn't do exactly what you wanted. But you want to make sure that no matter what that trade does, you are able to still come back, take the next trade and recover, take the next trade and then recover a loss you might make, even if you don't make any loss. All right? There are ways to trade that it will be very hard for you to lose. But then even when you don't make any loss, you still need to use the right risk management and money management rules, all right, in order to be able to stay in the market long term and make appreciable returns, okay, sensible returns. Yeah, okay. So that is why we are going into this first. So risk management. So what's money management? What's money management? What's risk management? What's risk management? So when we talk about risk management, basically we are talking about how to manage how to apportion your money on a trade, into a trade, how to apportion your money into a trade in such a way as to protect your capital while making returns, okay? It's basically the method of apportioning your funds in such a way as to protect your capital, and make good returns on your money. All right, so that is what risk management is all about. That's what risk management is all about, okay? That's what. So this session is being recorded. So by the time I record it, I'll put it in a special place and then give you guys the link. So only you guys can access this class, except someone else who probably is in the class later on, you know. But for now, only you guys can access this class after I have recorded it and put it somewhere. All right. So now that's what risk management is all about. So when you are talking about risk management, the first thing we want to talk about is risk per trade. Risk per trade. Risk per trade. What is risk per trade? What's risk per trade? So risk per trade is the amount of money you are willing to stake on every trade. Now, when you are entering, every trade you take is an investment. And we know that if you're putting if you are investing money, that money to an extent is at risk. What that means is this: you cannot get a return, you can't get a potential return without putting up something at risk. All right? So there is no reward without risk. So in the forex market, it's the same thing. There has to be a risk for you to have a reward. There has to be a risk for you to have a reward. That's the way it is. So risk per trade is, now you have let's say you have capital of $1,000, right? So what is your risk per trade is that amount of money you are willing to put into that one trade out of your capital. So you have a capital of $1,000 and you want to tell yourself, you want to ask yourself, how much of this $1,000 am I willing to risk on this one trade? How much of this $1,000 am I risking on this one trade of that money? So you are not meant to risk. You are not meant to risk anything more than 3 to 5% on your money on every trade. Okay, when you risk 3% on every trade, that's a good amount, especially when you're just getting started. When you're just getting started, you need to risk no more than 3%. But as you get good, you can go up to 5%. You can even go more than 5%. All right. So, but let's stick with a baseline. Let's stick with a baseline of 3%. All right. So risk per trade is now the amount of your capital, the portion, the percentage of your capital. The percentage of your capital you are willing to put into a trade. All right. So that is your risk per trade, the percentage of your capital you are willing to put into a trade. All right. And this must not be more than, this should not be more than 3% as a beginner. So what that means is that if you have $1,000 in your account, you have $1,000 in your account. What is 3% of $1,000? What's 3% of $1,000? Can someone just tell me that? Let's make the class a bit interactive a bit. Well, not too many yet. Who knows what's 3%? 3% of $1,000 is what?
I think that's $30.
Okay, great. Okay, so 3% of $1,000 is $30. Okay, great. So now you've determined that you want to risk 3% on your account on a trade, and that is $30. So how do you know? There are people that they will place a trade, they don't know what the risk on the trade is. So at the end of the day, if the trade goes wrong, they will discover that 50% of their money is gone. They will discover it, that 50% of their money is gone. So now they are wondering what happened. How can even with stop loss, they discover 50% of their money is gone. So they are wondering, what happened? How come I lost this much money, right? So now, when we now take note, as we are starting, we are starting talking about losing, right? So it's not because we are coming to the market to lose. It's because we need to think like this in order to win. In the market, most times you have to think in terms of loss in order to win. You think in terms of loss in order to win, because you will not protect something that is not at risk. You agree with me that you will not make moves to protect something that is not at risk. All right? If you think your money is not at risk, you will not do what is required. 1 minute, guys. You will not do what is required to protect your money. Okay, so that's the reason why we start talking about risk management and all these things, because you need to think like that in order for you to have the right mindset to protect your capital. Because protecting your capital is a very vital thing. It's like you're staying in the game. You're planning to stay in the game. All right, that's the reason I tell people, when you make money, withdraw. Many times, make money, withdraw, so that you are seeing that it's like you are making money on your money. Don't just be going, okay, I want to have $1,000, I want to double it first. No, if you make 10%, take your money out. You know that you have removed 10%. So that when you make 100% of your money, you will know, right? You know you have made 100%. Now you know that the money you have in the market is free money. Then you cannot decide, okay, the next thing I need to do, I need to double that one first before I withdraw again. But first and foremost, your capital is off the table. All right, so you want to be able to do that. So that's why I said the first thing we are talking about now is loss, not because we plan to lose, but because we want to have the mindset of protecting our capital, protecting our money, first and foremost. All right, so when we start from there, then we will know how to make money and still protect it. Make money and protect it. There are people that make a lot of money one day and lose all the money in one day. So if you don't know how to protect money, you can make a lot of money, but you will not be able to keep it because you don't have the mindset of protecting the money. All right? At no value, you will discover that you are not making. You can take your money, make 100% today. If you lose the money at the end of the day, you are in a loss because you lost your capital. You made 100%. Now you lost everything. So it doesn't make sense. So protecting your capital, very important. So now when you have decided the amount of money, which as a beginner, like we said, shouldn't be more than 3% that you're risking on a trade. Okay, we're going to use $1,000 as a figure here, as our hypothetical figure here, right? So now you've decided you're risking 3% on your account, which is $30. So now, how do you determine exactly how to risk this $30? Now you want to enter a trade, and your goal is to risk no more than 3% of your account, which is $30, right? So how do you set your trade now in such a way as to make sure that you do not risk more than $30 or 3%? Like I said just now, there are people that will enter a trade. By the time they trade, let's say the trade did not go well. Let's say the trade lost. They will realize that they've lost 30% of their money or 50% of their money. They will realize it, they'll discover it. How did you discover? How can you lose this money without you knowing? It means that you did not know what your risk was. You did not know what your risk per trade was. That was why you had to discover that you've lost that money. All right? So there is no way you would discover that you lost that money. So there's a way to determine how you've determined already that $30, 3% is what you are risking on a trade. But how do you make sure? How do you set your trade in such a way that you actually risk no more than 3%? So that's what you do now. That's what we'll talk about now. So now, let's say you find a trade. Let's say you find a trade. That's what we'll talk about. Let's talk about stop loss. Stop loss. So now, stop loss is a predetermined point. A predetermined risk point in the market. Sorry. In the market, a predetermined risk point in the market, right? So beyond which your trade is not allowed to continue. Okay, so now take note of the word predetermined risk. Okay. Sorry, I made a mistake. So predetermined risk. Take note of the word predetermined risk. Okay, so your stop loss is a point in the market, is a predetermined point in the market beyond which your trade is not allowed to go beyond, is not allowed to continue. So what that means is this. Like I said, when starting, we are talking about protecting first, protecting your money, protecting your money. That's what we're starting from. It's very important, right? So now, if your stop loss is a point in the market that if your trade were to go wrong, if your trade were to go in the opposite direction you determined it to go in, you want the market to take you out beyond that point. You want the market to take you out beyond that point. You set a trade for a buy, for example, and then the trade did not start buying, started selling. You want to set a point beyond which your trade should not go, which means that it's a loss point. You've told the market that beyond this point, I don't want to keep losing. I don't want to lose anymore. That's what a stop loss is. A stop loss is actually a kind of order in the market. It's a kind of order. It's a kind of market order. Just the way you have different kinds of market orders. We're going to talk about market orders. I don't think that's not for today, of course. Okay. So it's a kind of market order. It's a kind of market order. So it's an instruction that you have placed on your trade. You've placed it as part of the parameters of your trade, that when a trade goes against you to a certain level, the market should cut that trade so that you don't go into a loss that is beyond what you planned for. So that you don't go into a loss that is beyond what you planned for. That is what a stop loss is. So for every trade, there is a way to determine stop loss. First of all, every trade should have a stop loss. First of all, every trade should have a stop loss. So every trade should have a stop loss. That's the first thing. But then there is a way to determine your stop loss. Okay? But before we get there, let's continue with what we're talking about. We're talking about risk per trade. So the reason we got into stop loss is because calculating your risk per trade cannot be fully done without understanding stop loss. All right? So that's why we started from there. So now, let's say you pick a trade. Remember, we said your risk per trade is 3%. Your risk per trade is 3%, which is $30 here. And then we are talking about how to determine exactly what your risk is with the parameters you set. You actually set parameters into your trade. Okay, you put parameters into your trade that exactly calculates your risk per trade. Which means that if a trade were to go wrong, you will not lose beyond $30. Okay, so the parameters, how you do that is, number one is stop loss. So when you set a trade, you pick a trade. Let's say the trade is for Euro USD. Let's say you pick a Euro USD trade. Pick a Euro USD trade. Okay, let's say you pick a Euro USD trade. All right. So let's say you pick a Euro USD trade. Let's say you pick a Euro USD trade, and then you want to place this trade, and then you have determined. Now, later on, we are going to discuss exactly how you determine your stop loss. You don't just take a stop loss of any number. You don't just pick a trade and you say my stop loss is 30 pips, or my stop loss is 50 pips, or my stop loss is 10 pips. You don't pick your stop loss like that. There are things in the market that determines how you pick your stop loss. There are points in the market that tells you where your stop loss should be based on where you took your trade. All right? So when you are entering a trade for a sell, for example, your stop loss should be around resistance, around the resistance. Or your stop loss should be, we'll talk about that in detail. But I'm just hinting you guys on this. When you pick a trade for a sell, your stop loss should be around a resistance, or around the key level, or around any point like that. That is a key level in the market. That is a point of market reversal. So those are where your stop loss points should be. All right? So that's where your stop loss point should be. So you don't just pick a random number, pick a fixed number and just say, okay, my stop loss on this trade is 30 pips. No, you have to, there's a way to determine it. And as we go on, you will understand this very clearly. All right, so, but let's take, for example, that your stop loss on this Euro USD, your stop loss on this trade, let's take, for example, that your stop loss on this trade is 50 pips. Let's say 30 pips. Your stop loss on this trade is 30 pips. Let's say your stop loss on this trade, you have determined that your stop loss is 30 pips. All right? So this is your stop loss. Based on all the parameters we talked about, let's assume we are entering a trade now. We're about to enter a trade, and the stop loss for this trade is 30 pips. Okay? So now, what have we done? We have determined three things are important to, first of all, risk per trade is, we've determined our risk per trade, which is 30 pips, which is 3%, which is $30, please, $30, all right? So now, two other things are going to help us set our trades properly in order to actually make sure we are not risking beyond 3% on our account on the trade. So that we don't wake up, we don't enter a trade and then wake up and discover that, oh, this trade didn't go well, or I lost 10% on my money. No, that should never happen, because we are going to, we are picking the right parameters to set that. So the first one is stop loss. We talked about stop loss now. The second thing we need to talk about is lot size. So lot size, after you have determined your risk per trade, all right? After you've determined your risk per trade, and then you pick a trade, and then you know that your stop loss is 30 pips. Your stop loss is 30 pips, right? Okay, so now, the next thing you want to do in order to be able to set your trade to actually risk 3%, which is $30, is your lot size. So for your lot size, if you are on your phone, if you're on MT4 on your phone, you will see it there as lot size. You see it as lots. Then on your MT4 for your laptop, you will find it here as volume. All right, volume is your lot size. Volume is your lot size. On MT4 for your laptop, it is called volume. For your phone, it's called lot size. Yes. So it's the same thing. It's basically how much you are placing into how much size is your account. Another word for it is position size. Another word for it, lot size. Another word for it is volume, aka volume, comma, is also called position size. Position size. All right. So these are all the words used for lot size. Position size, position size or volume, okay? So it's basically the size of your trade. Basically the size of your trade. Sorry guys, electricity went, but it will come back on the gen. So okay, so that is it. It's basically lot size is volume or position size. Okay, so now for you to really, like I said, for you to actually set your trade for 3%, which is 30 pips, $30, sorry, you need to now calculate your lot size. So what we have done now, what we have done here now is we have determined that this trade, sorry. So we have determined that our trade has a risk of 3%, which is $30. Then we have determined that our stop loss is 30 pips. So now what do we need to do? Remember that when we're entering a trade, guys, 1 minute. When we are entering a trade, it's stop loss that we use to enter that trade. So we're using stop loss to enter the trade. So what we are doing now is we need to calculate what is going to be our stop loss, what is going to be our lot size, sorry. What is going to be our lot size? That's what we need to calculate. So to calculate lot size, this is what we do. We divide our position, our risk per trade. We divide our risk per trade, lot size. So lot size equals risk per trade. Lot size equals risk per trade all over stop loss. So your lot size is risk per trade over stop loss. Risk per trade divided by stop loss. Risk per trade divided by stop loss. That is your lot size. That is the lot size you are going to now impute in this place. This place, it says volume. That's the lot size you're going to put here. Then you put your stop loss here. All right? So now, how do we do that? Let's look at this. So we have lot size equals risk per trade over stop loss. So in this case, our risk per trade is what? Our risk per trade is what? Are we following, please?
Yes, our risk per trade is 3% of our
$30.
Yes.
Okay, great. So $30 is our risk per trade. We now divide it by what is our stop loss?
Our stop loss is 30 pips.
30 pips, great. So 30 pips is our stop loss. So what do we have? We have $1.
Okay.
Yes, $1. Okay. So now what this $1 means, this $1, remember we're calculating lot size. This $1 is not our lot size. This $1 is the dollar value of our lot size.
Okay.
Okay. This $1 is not our lot size. This $1 is the dollar value of our lot size. So what is now going to be our lot size? All right, so let's proceed with that. So for us to get our lot size, we have to understand there are different, when you are trading, when you're opening an account with a broker, there are 3 different accounts. There are 3 different types of accounts. Hold on, guys. Let me shift this upward so we have space. Okay, so now we have 3 different types of accounts. Not just broker account now. These are the kinds of accounts that brokers give us. First of all, you have a micro account. A micro lot. There are 3 different categories of lots. which are still brokers. Sometimes they make it your account too. They'll tell you that they are giving you a micro account or a mini account. Brokers also use these words, right? Or they give you a standard account. A standard account. So, but basically it's about lots. There's micro lots, there's mini lots, and there's standard lots. There's micro lots, there's mini lots, there's standard lots. All right. So guys, let me, before I continue with this, Zoom is telling me that my time is running out. Let me just close this video and give you another link to join. So we'll continue from here.
Okay.
Okay.